In today's video, we are going to learn about the key takeaway from the book Beating the Street by Peter Lynch. Number 1 is that you should focus on the even bigger picture. Imagine that you are living in Belgium or some other country with seasonal weather conditions. One day in the winter, the temperature suddenly drops below 0 degrees Celsius. People start to panic. It was 20 degrees just a couple of months ago. What is happening? Is it the beginning of the next ice age? The media starts to produce daily headlines about how polar bears could die from the cold, how electricity will stop working, and how even hell may eventually freeze if this drop in temperature continues. Silly scenario, you say? Absolutely, but it's not much different from this one, which has happened on multiple occasions. Imagine that you are living in a country with a stock market, which price is determined by a group of emotional human beings. One day, after a bull market, stocks suddenly drop 15% from their previous high. People start to panic. The Dow Jones was 27,000 just a couple of months ago. What is happening? Is it the beginning of the end of the financial system as we know it? The media starts to produce daily headlines about how stocks may eventually become worthless pieces of paper and how investors should switch to money in the bank and bonds if they don't want to risk personal bankruptcy. Equally silly, yet this is a recurring thing from which we don't seem to learn very fast. Just like with the weather, stocks go through numerous cycles. This is a natural thing, as the price of the market is determined by you, me, and a bunch of other emotional characters that swing from optimistic to pessimistic and then back again. Peter Lynch says that the key to making money in stocks is not to get scared out of them. The stomach determines the fate of the stock picker, not the head. Whenever Peter Lynch himself feels the itch to sell all his stocks and prepare for the worst, he likes to remind himself of the even bigger picture. The even bigger picture is that during the last 30 years, stocks have outperformed bonds by almost 3.6% per year. And let's not even discuss money in bank accounts here. Despite the thousands of reasons that we've seen that the financial world may come to an end, stocks have been returning on average 10% annually. 1% per year versus 2.1% per year for bonds after inflation. Besides, if total disaster actually does strike, money in the bank will be just as useless as stock certificates. But if disaster doesn't strike, which is a much more likely scenario, the stock picker will be the richer man in the long run. At number 2, we have that making money in stocks is a combination of science, art, and legwork. So it's no secret that Peter Lynch became such a successful fund manager at Fidelity Magellan by investing in stocks. But how did he do it? He attributes his success to a combination of science, art, and legwork. Stock picking is partly a science, as great opportunities can be found by investigating the numbers that are presented in a company's financial statements. Peter Lynch has many such quantitative factors that he likes to see, and he presents some of them in Beating the Street. Growing sales and earnings, a reasonable price, low debt, share buybacks, etc. But if this was the only ingredient in picking great stocks, scholars and accountants would be the richest people on the planet, which they aren't. Successful investing is also partly an art. In the long run, a stock will be priced fairly relative to how its earnings are developing. The investor must understand what has been able to drive earnings in the past and triggers that can cause them to grow in the future too. A good way to make sure that you have a correct hunch is this: if you are prepared to invest in a company, then you ought to be able to explain why in simple language that a 5th grader could understand and quickly enough so the 5th grader won't get bored. The last factor is legwork. Stay busy. Peter Lynch himself visited hundreds of companies per year and read even more annual reports. He says that for every 10 companies you investigate, you'll find one where the story is better than the market is currently expressing. He also emphasizes that when investigating an opportunity, you typically stumble across another one. Peter Lynch's favorite question when interviewing CEOs was this: are there any other companies that you are impressed with? When the CEO of one company talks fondly of a competitor in the same industry, you've probably found yourself a good deal. Number 3. Use the earnings line to identify buying opportunities. First, sales and earnings must be moving. Second, buy at a reasonable price. In Beating the Street, Peter Lynch gives an interesting tip on how to quickly evaluate if the price of a stock is fair or not. He says that one can identify an opportunity by looking at the earnings line of a company. In the long run, the development of a stock will resemble the development of its earnings. Whenever we have reason to believe that the price of a stock is lower than what is fair compared to its earnings and expected growth rate, we have a buying opportunity. And if the reverse is true, we should probably sell. Let's take Meta as an example here. During the years 2008 to 2013, Meta's earnings increased from $4.2 billion to $12.7 billion, which is equal to a yearly growth of 25%. Let's say that we had reason to believe that Meta could continue this strong growth. As a rule of thumb, Peter Lynch thinks that a stock should sell at a PE below its yearly growth rate, so whenever the stock of Meta drops below a PE of 25, we consider it a buy. The earnings line represents what the value of the company should be if the stock was priced at 25 times its earnings. Meta could be considered a buy when the price of the stock dropped below the earnings line. There's more science, art, and legwork to be added before we can decide whether Meta is worthy of our money or not. If you're loving this video so far and want more content like this, make sure to subscribe and comment below. Okay, back to our discussion. Number 4. Search for overlooked stocks with strong owners. It pays to be a contrarian when it comes to investing. It can be very profitable to go to places where other fund managers and investors are afraid to invest. Look for companies that aren't followed by many analysts. In Beating the Street, Peter Lynch lists many of his investing principles, and Peter's principle number 18 is when even the analysts are bored, it's time to start buying. This typically results in a lower price than warranted. Moreover, an overlooked company is usually favorable from other perspectives as well. For one thing, the largest share owners are usually still the founders of the company and the top management. This type of skin in the game is great for the investor. You can rest assured that your interest and that of the management are aligned. Furthermore, the owners of the business are typically more well educated about the industry with overlooked companies. What you want to see are owners that have succeeded with similar businesses before. What you don't want to see is that the largest 5 owners of the business are insurance companies or other large institutional players. These people rarely know much about the industry, and they probably don't care much about the company either, as it most likely will represent only a small fraction of their total capital under management. So look for companies that Wall Street has missed and where the owners are well invested and capable of running such a business. Number 5. Look for great companies in lousy industries. Now, a quick quiz. Where would you rather invest your money today? 1. Internet and direct marketing retail. 2. Oil, gas, and consumable fuels. 3. Life science. 4. Energy equipment and services. 5. Metals and mining. 6. Software. Which ones did you pick? According to research from Fidelity.com, 1 to 3 are the top 3 performing industries of the last 5 years, while 4 to 6 are the worst performing ones. Peter Lynch would probably shy away from the first group and instead focus his legwork on the second one. Why? Because strong performance attracts competition. Everyone would like to start a business in the first of the 3 industries, while companies are dying like flies in the second 3. Peter Lynch recommends that you should buy the strongest company or companies in industries where the general opinion is that things have gone from bad to worse. As competitors fall, the market share of these companies will increase, as will their profitability. It won't take long before the stock price follows too. If you want to learn about the 5 traits from Peter Lynch on how to outperform the market, then click on the video showing now on your screen. If you found this video insightful, don't forget to like, share, and subscribe. Thank you for joining us today. Until next time, stay curious, stay informed, and happy investing.